Ladies and gentlemen, good day and welcome to the Q2 FY22-23 earnings conference call of the KARUR VYSYA Bank. We have with us today the management team of KVB represented by Mr. Ramesh Babu, MD and CEO, Mr. Natarajan, President and Chief Operating Officer, Mr. Ramshankar, CFO, and Mr. Srinivasa Rao, Company Secretary and Compliance Officer. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Thank you, and over to you, sir.
Thank you, Aman. Good evening to all of you. Welcome to our bank's earnings call for quarter 2 of the financial year 2023. Trust that you, your colleagues and family members are keeping well and in good health. My Diwali greetings and wishes to each and every one of you. All of you would have gone through our presentation reflecting our performance during quarter 2. I am pleased to share that our performance in terms of growth, profitability and asset quality are on the right trajectory and higher than the indications given during our previous interaction. I am delighted to share some of the key highlights of our performance during quarter 2, which is reflected in the business numbers. We have indicated an estimated loan book growth of 15% for the current year. We have achieved a year-on-year growth of 16% during quarter 2, and the fact that growth is inclusive across all business verticals, which augurs well for the bank. We expect the trend to continue in the current quarter, considering the busy season, fairly good monsoon, and structural changes implemented over a period of time, which have now started yielding favorable results. Our total deposits grew a tad lower at 13% year-on-year, as against expected growth of 15%, in tune with the policy rate hikes and the need to mobilize stable term deposits. We have increased term deposit rates by 70 basis points on 16th August and 1st September for 1-year maturity. The rates are competitive and comparable with other players, thereby enabling us to achieve a 13% growth in this segment, which was 4% for the first quarter. So the liability business team is in place and are active in the market to source stable term deposits. Going ahead, we will focus on this segment to improve our stable deposit base. Demand deposits continue to grow by 15% over last year. Savings bank segment grew at 11%. While customer onboarding continues to grow, there was some outflow too, as few high-value customers appear to have taken advantage of the spike in yields in other investment segments. We are monitoring this segment very closely and targeting to achieve 15% growth. Savings bank account interest rates remained unchanged during the quarter. We continue to keep our NIM over 3.75% levels, and for quarter 2, it was 4.07. Our cost of deposits remains flat at 4.08 over last quarter, in spite of hike in time deposit rates during quarter 1 of the current financial year, and the increased cost is compensated by growth in low-cost demand deposits. The effect of 2 interest rate hikes on term deposits, which I spoke about earlier, will have an impact in the coming quarters. I reiterate that we continue to focus on low-cost deposits so as to offset the impact of hike in term deposit rates and aim to keep the increase in funding costs at minimum level. Considering positive yield movements in advances, which I'll explain next, and investments, we are confident of maintaining a NIM north of 3.8%. Yield on advances has moved up from 8.27% to 8.55% sequentially. During quarter 2, MCLR rate went up by 15 basis points and EBRR by 50 basis points, followed by another 55 basis points, which will be effective 1st October. On account of these hikes, yield on advances will continue to move upwards in the coming quarters. As indicated earlier, 85% of our loan book is under variable interest rates, of which 52% is linked to MCLR and 33% is linked to EBRR. Remaining 15% loan book constitutes fixed interest loans covering deposit loans, auto loans, staff loans, etc. Non-interest income has increased by 48% over September 21, mainly due to increase in fee income as well as the write back of MTM depreciation on investments to the extent of 13 crores. Employee expenses remain flat both sequentially as well as previous year due to lower AS15 provisions. We expect that it will move up by 10% in the coming quarters considering the DA increase and increase in number of employees besides AS15 cost, if any. Employee count stood at 7,393 as of September 30th as against 7,262 at the end of first quarter. During the quarter, we have added 295 officers exclusively in the sales. Operating expenses have gone up by 17% over September 2021, mainly on account of increased scale of operations. However, it is within our budgeted levels. Increase in net revenue by 26% and operating expenses by 4% aided the reduction in the cost to income ratio at 46%, lower than 56% last year and 50% for the last quarter. We have been indicating that our cost to income ratio would be kept at reasonable levels, and now this is made possible because of our conscious efforts in keeping the denominator growing and the numerator at the required levels. We will continue to focus on this ratio and maintain it around 50% levels. Operating profit of the bank has been consistently increasing over past 5 quarters and increased by 56% over last year and 19% over last quarter, and this is on account of combined effect of higher growth, enhanced profitability and lower slippages. Our annualized gross profit to assets now works out to 2.64%, and we will continue to improve or maintain this upward trend. We have made a provision of 206 crores towards our delinquent loan book, mainly for aging of underlying assets and also to further improve our coverage ratio. Credit cost for the quarter works out to 0.33%, and for the half year it is around 0.56%. We have given a guidance of 1% credit cost on our estimated loan book for the year, and during quarter 2, we have front-loaded our provision requirements for balance sheet management and also for better tax planning. Net profit of the bank has risen to 250 crores, which is the highest ever number achieved in a quarter, registering an increase of 52% over last year and 11% sequentially. We expect that this uptrend will continue during the next 2 quarters. Return on assets has been consistently growing during the 7 quarters, and for the current quarter, it is at 1.16% as against 1.09% during the previous quarter and 0.86% during the corresponding previous period. We have indicated an ROA of 1.2% for the exit quarter of the current year, and we expect that we would comfortably surpass this number for the March quarter of the current year. Our CRAR continues to be at the comfortable level and is at 18.31%, and liquidity coverage ratio is maintained at a prudent level of about 100%. Gross slippages were at 131 crores during this quarter, which works out to less than 1% of our loan book on an annualized basis, which is in line with our guidance. Our recoveries, upgrades have surpassed slippages during the quarter, resulting in negative net slippages to the tune of 74 crores during the quarter, and this is the 5th quarter in succession wherein we were able to maintain this trend of negative net slippages. Technical write-off of 576 crores has been undertaken during the quarter, which was done for balance sheet management. Recoveries from this segment are showing an uptick, and we hope to improve on this front during the remaining part of the year. There was no sale to ARPs during the quarter. SMA 30 plus balances at the end of the quarter continue to be below 1%, 411 crores, which includes dual loan balance of 41 crore also. Due to lower slippages, recoveries and technical write-off, Gross NPA has come down to 3.97%. Our plan is to reduce it to below 3% level by March 23. Our net NPA level has further reduced to 1.36%, and it is our endeavor to bring it to below 1% level by March 23. The overall standard restructured book is at 1,231 crore as of 30th September 2022, as against 1,640 crore at the end of March 22. There has been a reduction of 409 crores, which is by way of closures, repayments, upgradations, and movement to NPA. 5% of the restructured book as of 31st March 2022 moved to NPA up to September 22. We hold a provision of 114 crores towards standard restructured book. Further details are available in slide 29 of our presentation. We continue to improve our digital offering to customers for better customer satisfaction and onboarding. We have successfully implemented digital onboarding of customers for opening of current accounts across the bank and are in the process of implementing the same for savings bank. Our digital lending system is working well and enables us to scale up our operations, enhances efficiency, besides quality onboarding of customers. We have enabled payment of customs duty through iGate portal, GST and income tax and other direct taxes through digital channel by interfacing with respective government authorities and the Reserve Bank of India. Our co-lending business with two leading NBFCs is doing well, and we are in the process of rolling out this service to two more NBFCs this quarter. We have tied up with a couple of fintechs for customer onboarding, and we are working with 3 more fintechs likely to be rolled out in this financial year. Our performance in business growth, profitability, and asset quality has been consistently improving over the 7 quarters. There are certain challenges we foresee, and we have taken steps to ensure that this growth trend continues sans interruptions through the following measures. Firstly, with the need to strengthen our liability business, particularly to take CASA mix to 40% of our total deposits and increase our stable term deposits, we have created a consumer banking department by merging the personal banking liability and personal banking assets business of the bank. For effective management, we have recruited separate sales heads for the verticals and also regional level sales heads in the market, and the team has started functioning from Chennai. The team is led by head consumer banking, who has vast experience in this line of activity. The team will oversee retail acquisition, assets, retail acquisition of liability, institutional and government business, task and third-party products. We have opened an exclusive retail branch in Hyderabad, which will mainly cater to consumer banking segment with focus on retail loans and retail deposits, and no commercial banking activity will be undertaken there. We plan to open 18 more branches during the current year, predominantly to source retail liabilities and assets, and 1 digital banking unit. Bank always considers MSME sector as a core focus sector of the bank. In the past, the lending business was exclusively managed at branches, and bank has established 15 business banking units across the country to manage commercial lending business, that is a ticket size of 5 crores and up to 25 crores, and 9 corporate banking units to manage commercial business ticket size of 25 crore and above. Business up to 5 crore is managed in the branches. Further, bank has set up a non-branch distribution unit, NEO, in Mumbai, and this unit has 14 centers across the country covering 40 locations and managing MSME business, focus commercial mortgages, lease rental discount and drop line overdraft. Business is sourced through channel partners, connectors and DSTs. With these changes, bank has started achieving a double-digit growth, and during Q2, bank has achieved an inclusive growth of 15% in the loan book. We are now in the process of creating emerging small business centers under small business group to exclusively focus on MSME business, that is for less than 5 crore exposure. We have recruited a senior executive who has vast experience in this line of activity. He is forming his own team, and this team will source business through direct sales channels, aggregators, and partnerships beside DSAs and DSTs, and scale up the business using bank's digital lending platform. We are planning to establish new centers in few potential locations during the current financial year. Let me conclude by reiterating that we did well during quarter 2 and our performance is in line with expectations, business plans and guidance. We have demonstrated a consistent satisfactory performance during the past 7 quarters in different challenging environments, and this is well reflected in ROA moving gradually from 0.19% in third quarter of December 20 to 1.16% in quarter 2 of the current year. We are confident and hopeful of maintaining, rather improving our performance during the next 2 quarters. Once again, I thank you all for taking time to join this call. I will be glad to respond to any questions which you may have. Yeah, over to Mr. Aman.
Thank you very much. Yeah. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir. Let's have a set of numbers. So my question is around our deposit franchise. Okay, so in our PPT we do share the ticket size wise deposit breakup, and when we look at the deposit base, above 5 crore of ticket size. So that bucket has actually doubled in last 4 quarters. So it used to be 5% of the total deposit, which has been increased to 10% of total deposits now, which essentially hinting at incremental deposit is largely coming from the above 5 crore ticket size. So can you throw some more light on this? I mean, is this the strategic move or how one should look at this trend?
Yeah, thanks Renish, thanks for the compliments. And one thing I just tell you, suppose if you look at last 2 years, when the credit growth was not that much was there and all, so even if you take these deposits also, the bulk deposits of our customers, I am talking about all these bulk deposits, they are all our customers for decades. So we were discouraging them, saying that we are not interested in these deposits. In the process, they all have gone to other banks. So now, what we thought is, even if at that time we will take it also, we'll have to place it in a reverse repo, so which will be counterproductive. So now that the deposit franchise is required, the credit growth has picked up, so we have reconnected ourselves with our customers and told them in the process what all maturities are happening with the other banks and all, they are bringing back to us, because earlier they were dealing with us only. In between, we only told them, but we cannot accept at this stage and all, we do not want to pile up the deposit. So that way, the deposits of our customers, we are getting it back. It is literally homecoming for them.
Okay, got it. So this is a bit of a, let's say, a balance sheet management kind of a drive.
Correct. And not only that, the relationship in a sense that when the deposit market has hotted up and all, then there will be few more bankers and all, they will be wooing. In the process, I may be losing the total customer over a period of time. So now if I get also, at least they will be in my fold forever. That's the point.
Got it. So secondly on the margin side, of course, so this quarter it is 4%, and then as you rightly mentioned in your opening remarks that second half the pace of increase in cost of deposit will be slightly higher than the asset yield expansion. So how one should look at the second half of 23 NIM trajectory? I mean, should it be a downward trajectory or it should sustain at where it is currently?
Now, Ramesh, you would have heard that what all the guidance we have given, we said that 3.8 plus we will maintain because something may be transitory. But for the sake of clarity, I'll give you the full picture. Now, when we talked about our MCLR book, MCLR book comprises of the working capital loans. So working capital will be over a period of 1 year they get repriced. So this is the peak period, next 6 months, and all these working capital accounts get repriced. At the time, the new MCLR rate will be passed on to them. Currently, all this portion is passing to the old rates. Whereas EBRR is concerned, straight away we are able to pass at 33%, but 52% is a process going on now. So that way, there is a possibility of the yields going up on the advances front also. So that way, the deposits also, if the cost goes up, if the yields what all are going up as well as the deposit cost going up, we will be able to maintain. But whatever it is transitory. So we still mentally have a feeling saying that we need to maintain 3.8% and above.
Got it. Because first half we are already higher than that. So.
No, absolutely. That's why we want to be frank. So if, as long as we could get the benefit of it, we will take it. Not an issue. But so this cannot be a permanent feature. So we need to look at it. That's it.
Got it. And I mean, is it fair to assume that, let's say, if we want to compromise, a 10-20 basis point of margin to chase higher growth, are we open to that?
Yeah, we is open to that, but the only issue, understand, so suppose you are currently at 16%, suppose if you are growing at 20%, simultaneously you need to grow deposits also at 20-22%. Suppose if the systemic liquidity is not there at that level, if you press accelerator button on the advances engine, at one point you are unable to dispense that sort of a rate and all, it will be embarrassing in the market. So that way we need to go in a calibrated way, how much you can mobilize the deposits, how much you need to go it and all. So now all verticals, earlier, a particular vertical was doing and all, others were piggy riding on that. Now the question is, every vertical you are able to find a double-digit growth. So that way, pressing them and taking it forward should not be a much issue. So that's why we will look at both. How is the liquidity position, how is the growth and all. Accordingly, we will take it forward.
Got it, sir. Got it.
Okay?
That's it, sir. Thank you, sir. And all the best.
Thank you, Ramesh. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead. Jay Mundra, your line is unmuted. Request you to please unmute your line and proceed with the question.
Yeah, hi. Am I audible now?
Yeah, audible, Jay. Please go ahead.
Yeah.
Great, sir. Thanks for the opportunity and congratulations on a great set of numbers, sir. I have few questions. So, first is, sir, you had said that we have started adding branches and we have started adding manpower also, and of course there is a pickup in the business volume. So, just wanted to check, sir, how should one look at the OPEX growth in the let's say coming quarters and coming years?
Yeah, Jay, in fact, we need to see because OPEX, what all we have factored, that budgeting and all. So that will be within that, because if we do not open the branches and these things at this stage, particularly for the liabilities, we want to recruit the people. So this is an investment we need to make. So we may be reaping the benefit with a lag of 6 months or so, but that investment is very much needed. But when we are doing this ROA tree and calculations and all, so we have factored all these things into our account. So correspondingly, the increase in the income also has to be there, so that the ratios are not vitiated. And overall, what all we have committed on the ROA front also will come up and all. So both the organic growth will have to happen and ratios we committed also will have to be there. That's what we are planning.
Right. So, sir, the OpEx growth for the, let's say, should be lesser than loan growth, right? Is what is implied?
Agreed, but the question is, suppose loan growth will happen currently. OpEx growth, something which is a capital expenditure, if you do not do it now, so you may have to branches all these things and expenses and all, current and rent and all. So you will not be able to get a benefit after 6 months. So that way there can be an overlap in the OpEx to some extent. Likewise, you are recruiting many people for the liabilities now. So from day one they may not be able to do it and all. Even if they mobilize the deposits also that need to be deployed. So this will take some time and all. That's why we thought that an overlap of 6 months, now that the position is relatively better, we can think of spending on this for the future.
Right. No. So I don't doubt that, sir. I was just asking that would OpEx growth be similar to loan growth, or it could be, let us say, lower than loan growth of, let's say, 15%?
No, Jay, whatever currently the 6 months of this OpEx growth is as per our estimated lines. And again, 18 branches which were proposed to open, these are all not in the metro centers, but all in Tier 2, Tier 3 centers. And we don't think any substantial cost will be added in the operating cost. But we have, in our working, while budgeting for this year, profitability and fit, we already taken this 18 branch and all well within that the budget whatever we have planned. So for coming back to your question about whether it is equivalent to 15% or 16%, we are also expecting on the same lines.
Right. Sure. Second question is, sir, on your savings account rate, right? So I think now you are probably the lowest in the lower bucket at 2.25%, and our highest is 3.25%. In the last few months, other banks have raised the savings account rate. We have also done on term deposit side, but any thoughts on revising the SAR rate upward?
Yeah, Jay, in fact, many times, 2 to 3 times, we did a homework on either the reduction or increase in the savings bank. Increase if it is giving huge inflows or reduction outflows are happening. So 2 to 3 times when we saw, it is not that elastic and that way is not straight away linked to the rate and all. The marginally here and there, the change is there. So, but if you change the rate on the whole portfolio, it undergoes change. That's why we are tracking continuously ALM level, we are looking at it and all. As and when it is required and all, we will change the rate.
In addition to that, Jay, we have a specific product called Rainbow, where there is a sweep facilities available. So it is anyway directly linked with the deposit rate. In case the customer demands, probably we can link that account to that. So that in that way, we don't think that it is essential for us to review this savings bank.
Auto sweep is there. Overnight, the money will go into the time deposit.
Right. Sure, understood, sir. And sir, you also mentioned on the asset quality side that now we intend to bring GNPA below 3% and net NPA below 1% by March. And we continue to have slippages, net slippages as negative level, right? So, I mean, it looks like that trend should continue, and hence, even if you were to reduce your GNPA from current 4% to below 3%, which is like 1% reduction, this would be aided by, negligible net slippages, right? This is and hence there will not be too much pressure on the credit cost. Is that what is being implied?
Yeah, absolutely, you are right. So, agreed, our endeavor is to keep the net slippages negative, but so it may happen here and there some quarter, but whatever it is, overall what you said is correct in the sense that this net slippages, they will not have much bearing on the provisioning because the recoveries what all are having. So the provision what is to be released there, majority will take care of the gross slippages what all are coming. Because the many of the slippages, old slippages are there, it can be in substandard or doubtful 1, 2, 3. So that way the provision what all gets released. If an account has become a slippage NPA now, substandard 15%, it will be able to take care of that. But whatever it is, we are trying to have a tighter control even on the slippages. That's why if you can see it, our corporate SMA 30 plus as at the end of September is 0. 30 plus 0. So likewise, if you look at it, we are trying to have a control on the slippages and focus is more happening on the recoveries thanks to the post-COVID environment, the courts are working and all, the auctions are happening and all, that way we are able to do that. But as you said, overall the position is like that only because, so for this balance sheet management, once we complete this provisioning and all, later it may be on a self-sustained basis, the recoveries as well as the slippages.
Excellent, sir. And last question, sir, from my side is, if you can share the few details of the lateral hires that we have done in the last few quarters. I think you had mentioned that we have hired a new person who is setting up his team, which area, and we had hired, I think, National CASA head, and if you can highlight, few of the lateral hires that we have done.
Fine, yeah. Because what we thought was in the month of March itself, so we were foreseeing the demand, what it comes up for the deposits. From then onwards, we started scouting, and one of the big private banks, whoever is there and all, from there we have got one CASA national head, and he will be stationed in Chennai, and along with him the regional sales heads also, and others also we are recruiting them and all. These people, they'll have a feet on street. Literally, the feet on street, what all the mobilization, the business development associates, all these people who look after the liabilities team, this team will separately handle. Currently, these some here and there, the work the branches are doing, the focus is not that there. So that way, this national head CASA, who has come from the private bank, he will be holding this responsibility and all, he will take it forward. In addition to that, we have taken another national head for the government business as well as task also. So she is also having a good experience and all, we have taken from another private bank there also. And that way, now that we are well equipped to handle the government business integrations, these things are over now and all. So there can be many opportunities for us, both for the government accounts as well as the customers who have these payments and all, who are dealing with other banks and all. So they will handle not only the government business and task business, what all is there also. A separate strategy is being worked out. So that way, these two wings separately they'll work. In addition to that, one more person also from another bank we have recruited. He is head of the third party, that is a cross-sell. So he will be in charge of taking care of all our products, how methodically we need to do it. He has an earlier experience working in an insurance company, in a bank also. So with the blended exposure what he has, so he will be able to bring out some sort of a practical solutions for us. And there also we are creating the structure for doing this one. So all these things will go under the liabilities consumer banking wing. So Jay, as I said, these things, initially when we are spending, it may involve some cost and taking the people. But 6 months of period, over a period of time, once we start getting our raw material engine, they will be continuously pumping. And if you are growing on the advances front, we should not actually stare at darkness. That is the intention. So we are making all these adjustments and all, so that once this new setup what we have created, so mainly to focus on the liabilities acquisition. The branches will be focusing on the term deposit with the connections what all is there and all. Likewise, the new acquisitions what all have happened and all, deepening also will be taken care of. That way, total focus we are giving on this vertical, how to take it forward with that.
Excellent, sir. Yeah. Thank you, sir. All the very best and festive greetings.
Thank you.
One more, Jay, please, one more thing. One more thing, just another initiative also what we are taking will tell you, though it is not connected to the liabilities, bank is focused on the MSME, because you would have seen that our percentage of the total advance is 32-33% that runs. That is one of the areas which will give a yield of 10%, and the book is totally secured by the entire collaterals are there. So what we thought is for the branches where the locations are there, where we're doing, there are many locations where we do not have a presence but still position is there. Likewise, few market related products are required. So that is the reason we have again recruited from another public private sector bank an SME head for the, in my inaugural speech I was mentioning, emerging small business group. What they will do, more or less on the lines of a NEO. So they will have their own feet on street, relationship managers, underwriting team, and the connectors as well as DSAs. So these people, they'll be mobilizing from the market below 5 crore business. Because below 5, now currently above 5 crores, we have a relationship banking through business banking. Now we are bringing it down to the below 5 crore also. there's a lot of scope available. That way the branch channel, what all is there, they'll be mobilizing, but this channel also, we need to grow and mobilize good business in that. In that process, initially we want to start with somewhere in Coimbatore, Chennai and Hyderabad and Bangalore. These 4 centers we have in mind. Most probably next month the team will start coming. Once they start coming and all, we will start working on this. By the end of this financial year, we will be able to open few centers for the emerging business. So that way we want to give some more fillip to the commercial wing also.
Right. Understood, sir. Sir, just on this, so this is like, wouldn't there be an overlap between the business that branch will solicit and this team will solicit, right? Because all branches are also doing below 5 crore business.
Yeah.
This team will also do 5 crore business, and
Right.
the centers that you mentioned, you have a decent presence there, right? So wouldn't there be an overlap kind of a thing?
The same thing we thought, Jay, when we were starting Neo. Then now the question is, the market and pie is so big, even if both are working also, there is enough scope. Now if you look at it, Neo on an average 125 to 150 crores on their own they are growing, and never branches, and these people, they felt them as a competitor. Suppose if we are not getting, some other bank will get the business and all. So that way the sort of a synergy has come in Neo. The same we want to replicate here also.
Sure. Excellent.
And one more also, Neo, when we are doing the lab business, there is a lot of opportunity for providing working capital for them. Their working capital is with some other banker that we are yet to acquire. Suppose this sort of team comes up and all, they can work in hand with the Neo team and all. The working capital accounts of those banks also, we can target that.
Right. Great, sir. Yeah.
Thank you.
Thank you. Next question is from the line of MB Mahesh from Kotak. Please go ahead.
Good evening, sir, and congratulations on a good result. I'll just keep the question short because there's a bit of noise in my background. The situation with respect to export slowdown in the area of Tirupur, Coimbatore, what is your sense speaking to them, and how are you reading into it? That's it. Thank you.
Yeah. Thanks, Mr. Mahesh. Thanks for the compliment. Now, agreed, we have an exposure of 8% in the textile, and that has different levels. There it can be home textiles, there's yarn, spinning, all these things. So we are continuously gauging what is the position of that. So now, agreed, yarn currently the demand is low in Tirupur and all. So over a period of time, it may pick up and all. But few pointers, if you look at it, last 2 years, that people are saying that these machinery manufacturers for the textile, their order books were pretty full and all. We were also expecting there will be good demand from our textile customers for the expansion. But incidentally, there are only 2 to 3 customers of ours who have come for the expansion. They didn't go for expansion. So second thing is, even if someone has gone for the capex also, they have come only for the solar and these sort of things only, and not for expansion. That way, if you look at it, many of the exposures what we have, the customers, they are seasoned, they are in the business for a long time and all, and they know these sort of ups and downs how to manage, and they do not want to over leverage themselves also. That is the reason when the position was good also, they didn't expand well. So that way, if you look at it currently also, the corporate, including textiles, when we talk about, now no account is under FY23 plus, but we are closely gauging the position here and all, how we need to take it forward, and we will see that.
Yes, sir. Just one clarification on another point that you made. You started indicating that there will be higher OpEx on salary from next quarter pertaining to DA. Can you also clarify on that?
Yeah, I agreed. If you look at our what all we have budgeted for the staff expenses, we have initially indicated it can be around 1,071 crores or 1,100 crores. So we feel, so even if some sort of a spike is there in the DA, on the other side, what the benefit we get in the pension and all gratuity, these sort of incremental contributions, what we need to do, both of them may get offset and all. That way there may not be much spike in the staff cost is concerned. But even if here and there, 10-20 crores here and there is there, but the growth in the income side is much more than the growth in the expenses. So that way the ratios will not alter on account of this.
Okay, sir. Ma'am, thanks a lot, and best of luck, and congratulations for what you have done.
Thank you very much. Thank you.
Thank you. Anyone who wishes to ask a question may please press star and one at this time. The next question is from the line of Anand from Emkay Global. Please go ahead.
Yeah, thank you for the opportunity and congratulations for good set of numbers. So firstly, on your savings deposit, you said that the person has come on the CASA front somewhere in March. But if you look at the current savings deposit for the quarter, seems to be down quarter-on-quarter. So how is it really playing? Because the numbers certainly are not talking what basically we have done on the ground. Number one. Number two is that you talked about the fintech partnerships. So what are these fintech partnerships doing basically? Which field are they operating into? Are they into SME business, business banking, or primarily into retail? And what is the overall contribution of these fintech partnerships on the asset side? And any plans to onboard any of these fintechs also on the liability side? These are my questions.
Thank you, Anandji. Thanks for the compliment. No, there is a small communication gap, what you understood. We started thinking and identifying the problem from March onwards, but when we started scouting in the market for a good head, it took some time. So finally, more or less in the month of June, July, we are able to finalize, and the new head has come and reported in the last week of September. So that way, he has just reported here and all and forming the team and all. So it works that way. Now coming to the reduction in the CASA, the SA balances, what you mentioned is, so if you look at our YTD numbers are there, first quarter of this year, so we have got sizable inflows which are chunky and bulky amounts have come. So it was there for some time and all, and few of them which have gone out. That way, overall, if you look at it, though the new acquisition was there and the average ticket size was going up also, because those lumpy accounts who are there, balance and all, including the government accounts for the payments and the schemes and all, when it has gone out, so that way you are able to find a marginal difference there. Otherwise, the inflow, new accounts opening, acquisition, all these things are going on as it is. And now that the new CASA head has just reported at the end of September, so the activity will start working in 1 or 2 quarters that you can find that. So coming to fintech question, what you asked, our president will respond.
Yeah. With regard to whatever the fintech tie-up currently we have, it's not a big business level, but it's all completely tested and going on well. So what we are planning to do is now, out of the 3 fintechs, one is on the liability side, and the initial working, everything we are doing it. Basically, we will be concentrating on the Gen Z. So it's a startup, and we like the product and we like their vision, and we are working together with them to create the suitable infrastructure and process for that. And the second fintech is for the agri-related product. So where we felt that the fintechs are doing very well there, and whatever gaps we have in our capability, I think they are in a position to offset that. So that is why we are working with them for this product. Prima facie, we are not planning for any unsecured loan products, and whatever we are doing it is by and large either in liabilities or secured product.
Okay. Now, also, what is the skin in the game for these fintechs? Basically, barring sourcing loans for you, are they into collections as well? Do you have kind of FLDG arrangement with these fintechs or no?
So currently, as per the regulatory guideline, whatever existing also, we have discontinued the FLDG thing, and we have realigned our commercials within the compliance, within the guidelines of the RBI. And going forward also, we'll go by that. But what we are currently looking for is on the liability side, it's onboarding of new customers and also the good customer experience that we believe that the fintechs will be in a position to deliver. So based on that, that will be good value for the bank. Over a period of time, we'll be in a position to add more number of customers. As regard to the agri-related the business, definitely there will be the value in terms of a loan.
Yeah, Anandji, just to add I want to add one point. You were touching about a point on the collections. So what we did is the last 6 months, so I can actually say 3 months, so we have actually from within the bank, we have identified a senior executive who has the well experience in the collections, as we made him as a collections head. And we brought the call center also under him, as well as the feet on street, what we are engaging the agencies also and the branches under them. Now we are in a dialogue with one of the fintechs who have a sophisticated model for the collections also digitally. So our wing is, our recovery wing is working with them and all. If it suits well and if we find some value, we'll be able to get it and all. We'll partner with them.
Sure. And the third, if you look at the kind of profits that we are now running, and I think Mahesh was also talking about some problems that we have in Tirupur. And secondly, if you look at the way the SME business could get dislocated if the macros turn bad, is it not prudent on our part basically to make some prudent additional provisions rather than running down on the overall provisions, writing off loans and showing higher profit numbers? So any thoughts over there?
And a point well taken. The question is, we are looking at the SMA 30 plus. So 30 plus, suppose if any signs of these sort of weakness are there, we thought of doing it. So that way, when we look at it, including these MSME portfolio, the overall SMA 30 plus is 411, which includes 40 crores of agriculture also. So hardly it is coming to around 360, 370 crores of SMA on a book of 62,000 crores. So we will look at this one. But first of all, for the balance sheet purpose, what all we are doing, and there may not be much need for the provisioning also. We can think of doing all these things also, not an issue at all. So point is taken.
So, but I mean, the signs will really not show up now, particularly when the markets are buoyant. I think that will happen maybe 6 months down the line, 12 months down the line. And the way basically you paid on CASA fund to some extent, right? I think that on that side also the signs will come later, but I think what to provide from now on.
Fine. Okay, I will note the point and I will examine that one, Anandji.
Yeah. Because what happens is that we are running a high on profit numbers, showing good numbers. And if we don't provide well, possibly later point of time, we might not be able to even touch 1% ROE. Because this is what we are seeing across the cycle. This is what happens 1 or 2 good years and then basically we lose quarter.
No, agreed, Anandji, but just one point what I want to say. Now suppose even if ROA of 0.1, 0.16, 0.12 comes up also, if you look at our current net NPA is around 800 crores. Suppose if by the end of this year, if it comes to around below 500 or 400 crores, whatever it is I'm saying that and all, if the requirement for the additional provisioning is not there, then the question is many of the accounts which are in advanced stage of recovery, they'll be releasing the provision. And not only that, because additional provisioning requirement in the normal course is not required from the profits what we are generating also. That plus this will be able to manage if at all the additional stress comes. But whatever it is, what you said is correct. Along with our risk management department, we'll work on that and all. What we need to see, we'll have a working on that.
Sure, sir. Thanks a lot for that.
Thank you.
Thank you. The next question is from the line of Sharad Jitur from Zen Wealth Management. Please go ahead.
Thanks for taking my question and congratulations on a good set of numbers. So can you just please elaborate more on the write-offs during this quarter? That's one question. And second question was about the moratorium portion of the restructured book, and can you also please give some color on the steps over there? That is second. And my question on MSME was well covered, but I would like to get more insights into the future steps and steps being taken by the management to address that stress. That would be more helpful for me, and thank you.
So suppose if write-off, if you look at it, so this quarter we have written off 576 crores. So that we have given in the presentation also, if you can look at it that way. So these amounts anyhow fully provided, that is the reason we are able to manage the balance sheet, we have done that. So, but it is only a technical written off, that doesn't mean that the focus will not be there. As far as the recovery department is concerned, it is as good as a normal NPA only. Only for the balance sheet management it has gone out and all. The same amount of attention it will get what we are doing for a normal NPA account. So this is the first part. And second part is what? It's a restructuring.
I think you are talking about the moratorium and the restructured account, right?
Yes.
Okay, so for example, in terms of count, the 97% of our accounts already repayment started. For example, we have the restructured book of 1,231 crores as of 30th September, and it was 1,640 crores as of 31st March. And in terms of value, 87% of our the restructured loan book already the repayment started. And whatever stress, everything is included in the SMA it's 30 plus. That is one of the lowest in the bank. So in that way, we are not now the entire restructured book is less than 2%, and we are not that much concerned on the recent book. But having said that, we have a complete track on these accounts, and there will be a complete follow-up system is put in place, and we are continuously monitoring these accounts.
Yeah, Mr. Sharad, one more point just I want to add here. You see, out of our restructured book, 68%, that is 837% of the accounts, there are no previous record of SMA. Because of the COVID at this time, they took it. Otherwise, before that, it was not even an SMA. So that way, the quality of the accounts, what all have come, are good. If you look at it also from March onwards, the delinquency slippage is around 5%. So in addition to that normal provisioning, we have provided something more also for the restructuring. And that way, this 1,200 crores, which comes to around 1.9%, should not be a major issue for the bank. And second point also I'll share with you. All these portfolio, what all is there, majority is backed by 100% collateral. Okay. So if at all something happens also, it's a question of time of 1 year or 2 years and all, but you'll be able to get back your money.
Okay. And yeah, thank you very much. And my other question was on the MSME book and the stress over there. What are the steps being taken by the management to?
That's what we were telling. Suppose SMA is concerned, so which is 32%. If you look at it, the SMA 30 plus what we are disclosing, it includes SMA also, MSME also, including that it is 0.66 and all. So which comes to around 370 crores out of 411 crores, 40 crores agriculture gold loan if you exclude it. So 370 crores on a book of 62,000 crores.
Okay, fine. Yeah. Thank you very much. Yes.
Okay, thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. B. Ramesh Babu, MD and CEO, for closing comments. Thank you, and over to you, sir.
Thank you all, gentlemen, for taking out time. A long weekend is there, but despite that, how much of interest you have towards the bank is very well known. The intricate questions what you have asked and suggestions what you have given and all. So we will continue and strive our effort to take it forward that way in every point what we have guided and all. So once again, a happy Diwali to you and your family members. Take care. Good day to all of you. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of the KARUR VYSYA Bank, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.